Now we're going to look at a example for the company from the textbook, our Majestic Mulch and Compost Company. So we have various information about this company. We have estimates for the 3 years of sales for this project that we're trying to evaluate. We know the variable cost per unit, our projected sales price per unit, our tax rate, our required rate of return on the project, that we have to buy equipment, and that equipment has a useful life of 8 years. We're going to use the 7-year makers table to depreciate it. So we take all of this information and use it to project what our cash flows are going to be for the years of this project. So if we look at the next slide, we can see that we have projected out all of this information. Our equipment costs $80,000. We also have a net working capital investment at year 0 of $20,000. So the year of our investment or our project start is always year 0. We consider it an ordinary annuity where cash flows happen at the end of each year. We then use our projected units and our sales price and our variable cost price to project out an income statement. The depreciation amount is the cost of the equipment, the $800,000 times the maker's rates. And of course, we're going to do an example for the just like this so we can actually see the calculations done step by step. We have our taxes based on our tax rate, add back the depreciation, and that gives us our cash flow from operations. We also have that the net working capital requirement changes every year. That is generally as a percentage of change in sales. At the end of the project, we believe that we can sell this piece of equipment for $126 or $126,400. So that is a cash flow during year 8. This gives us our total projected cash flows for our initial investment and all 8 years of the project. We can then discount those cash flows back and get our net present value, look at what the payback period is, and the internal rate of return for that project. So this cumulative cash flows, that is calculating the payback period. So that's where we calculate that the payback period is 3.79 years. The discounted cash flows here are what are used for the net present value and internal rate of return calculations. When we're looking at this net working capital calculation, so this is just looking at that information up close and seeing it better. So our net working capital investment and recovery of net working capital. So as we sell products, we have recovery of net working capital. We have to make different investments in inventory, payables, accounts receivable, based on the changes in our sales. We have our pro forma income statements. We can see our sales minus our variable costs equal our gross profit minus fixed costs and depreciation equal the earnings before interest and taxes, our tax rate to give us what our cash flows are. Then we have our total projected cash flows, and we looked at each one of these on the big file, but we are just going through them, looking at them close up here. When we're evaluating the net present value of projects, we have to remember that those are only estimates. Those are our estimates based on forecasts that we made about a project. So when we come back to, so think about if we're launching a new product, those estimates are based on marketing projections for how well that product is going to sell based on some analysis that we've done. So we have a forecasting risk. So how sensitive are we to a forecasting risk? We have to look at sensitivity analysis or scenario analysis. So what happens if we overestimated how popular this new product was going to be and we actually sell well below our forecast? Or what happens if we underestimated how popular this product was going to be and we sell far above our required forecast? So we also want to look for sources of value. So really being able to describe why this particular project creates value for our company and our shareholders. When we look at scenario analysis, we generally provide a worst case, a base case, and a best case. This helps us to provide a range of possible outcomes. It is impossible to analyze for every possible situation or scenario. You can actually get yourself bogged down in analysis if you're trying to come up with perfect information. There's really no way to project into the future perfect information. We don't have a crystal ball. We don't have that kind of information available to us. So we're just doing estimates. So when we're doing scenario analysis, we're going to do worst case, base case, and best case. So this is an example of our base case is that we believe we're going to sell 6,000 units. Our worst case is that we overprojected and we only sell 5,500 units. And the best situation is that we underestimated and we sell 6,500 units. And so we look at the difference between the different scenarios. You can also see that in these different scenarios, we have changed our price and the variable cost and the fixed cost. You do not have to change all of your costs in all of the situations. You can just look at various components of it. Then we have full information about what these projects look like and what their total effects would be. Some of the problems with scenario analysis are that it really only looks at a few possible outcomes. Because it's impossible, we'll bog ourselves down with way too much information if we try to analyze for any potential outcome. It also assumes perfectly correlated inputs. So only bad things happen together and only good things happen together. You can see that if we can get our best price, that means we sell the most and have the lowest cost. Or if we get the worst price and sell the least, then have the worst cost. It doesn't take into account that maybe only one of those things changes. It focuses on standalone risk. We can also make subjective adjustments, and that is called sensitivity analysis. So sensitivity analysis shows how changes in one item can affect the net present value or the internal rate of return. Everything stays exactly the same except for one variable, and it helps us answer what if questions. What if we can't sell this many? What if we sell it for $80 instead of $85, but we still make our projected income, that or our projected sale? So we say we're going to sell 6,000 at $80. What if we sell 6,000 at $75? What if we sell 6,000 at $83? So it allows you to change just the one variable. This is very easy to do in Excel if you set up your information correctly. So you can see how throughout the course, we've had the information in a table above, and then we do our calculations in a table below. One of the benefits of that is if we've done all of our formulas below, I can just change one of the things in the table above, and all of my calculations in Excel will reset to show me what that change does. The strengths of sensitivity analysis are that it helps us to see which changes are more detrimental than others. So maybe it's our variable cost that we have to pay most attention to. Maybe it's our sales price. It helps a little bit with break even information. Weaknesses are it doesn't reflect diversification of our information or our product line. It ignores relationships among variables. So, how do our variable costs affect our sales price? And if there's a relationship, it says nothing about if it is likely or not to change a variable. And the disadvantages of both sensitivity and scenario analysis is really that it just gives us information about scenarios or situations. It's a standalone risk. It doesn't show us huge picture. It doesn't give us a hard decision rule. It just gives us different information about the potential impacts of things that are going to happen or could happen. When we're looking at capital budgeting, we have multiple options. So we have contingency planning, the option to expand, the option to abandon, and the option to wait, and other strategic options. So when we're looking at So when we're doing contingency planning, we have to think about that that's part of our what if. What if we do this? What if this happens? So really when we're thinking about our option to expand. So what happens if we do this capital budgeting project? What are the options for expanding that project? What if we decide to do one existing product line? Well, how can we expand on that product line? Can we make new products from it? Different formulas, different variations, different colors? Are there different markets that we can tap into that we've never tapped into before based on demand? What is our option to abandon the project? What if once we start the project, we realize that this is not a good thing? Something happens. Um, the project doesn't take off like we thought it was going to. Uh, our sales were far, far below our worst case scenario. Um, can we temporarily stop the project and make some changes, or can we abandon it altogether? Maybe we just want to scale it back a little bit. Maybe we want to completely abandon it. Or the option to wait. Just because we're looking at different capital budgeting projects doesn't mean that those projects mean that if we don't take them on right this month, that they couldn't happen later. And we might want to wait for a variety of reasons. So maybe when we're looking at expanding into a new product line or building a new building, we do some analysis and it seems like a really good idea, but then we strategically decide that maybe we need to think about this a little bit longer. And so we're going to put off that decision for a year or two. Not that we're actually saying no, we are just saying not right now. And the strategic options are what options do we have for the future? What are other options that we have for additional capital budgeting options or for future capital budgeting options or new product lines, new expansions, new buildings, etc. Maybe what happens is if we take on a new product line now and we have research and development working on something that could potentially happen in 3 years, can we still also do that project in 3 years when research and development gets done with it if we already have cash and money tied up in what we're doing now? So that's when we're thinking strategically about any projects that could be coming down the pipeline and future decisions. Another thing that we have to think about is capital rationing. So capital rationing is just a fact of life, honestly. So capital rationing happens to us every day. What if I want 4 things that each cost $100, but I only have $100? I only get to choose one of the 4 things because that's how much money I have. So capital rationing occurs when there's limited resources, such as limited cash. We only have $5 million each year set aside for new capital projects or new projects. So that's an example of soft rationing. Soft rationing means that we put rules on ourselves, or for some temporary reason, we can't take on an additional new project right now. Maybe we're waiting until the market settles out after it's been particularly volatile. Maybe we just had a new bond issue, and part of that bond issue's requirements say that we can't take on a whole bunch of new projects. Maybe we want to maintain our debt to equity ratio, and that limits how much additional projects we can take on. And hard rationing means that the capital will never be available for this project. So this generally happens when there is a major liquidity issue for a company. The company can't take on new capital. There's some reason why the company could not get equity for whatever the project is. When we're faced with capital rationing, we might look at the profitability index as a decision tool. We might make structured plans for decisions. So maybe we make a 10-year capital budgeting plan, and that we use that to help bring in projects. So we can say, okay, well, we have to finish these projects before we can start new projects, depending on what the money is. So there is a variety of ways to plan, even when you're faced with capital rationing. It is rare that companies just have the free cash flow and the ability to raise millions upon millions of dollars to take on any project they want at any time.